Hi, everybody, and welcome to another episode of our Made for YouTube series. And before I begin today's video, I want to actually just, you know, offer my condolences to all the people who may have lost family members or loved ones in the second wave of the pandemic. And, all we can offer are words and support and an appeal to everybody out there to please stay at home as far as possible. If you must go out, then please maintain social distancing, wear a double mask, and as soon as you have the opportunity, please do offer to take the vaccine. Having said that, let's begin today's episode. And today is amidst these times. It's always fruitful and positive to look at the long term. So I thought we would, look at how you can invest for the longer term. And I know we mostly talk about mutual funds, but the effectiveness of your mutual fund is dependent on the effectiveness of the team that's managing it, right? The fund management team. So, what exactly is it that defines this effectiveness? And as advisors, we say that invest for the longer term. Don't invest for the very short term. So, therefore, is your mutual fund or are the fund managers managing it also investing for the longer term? Are they aligned with this principle? So let me invite today Jinesh Gopani, who's the head of equity for Axis AMC, to talk about exactly this, which is how do you invest for the long term. Jinesh, thanks very much for joining in, and I hope you, your family, colleagues, loved ones are all safe. Thanks very much for joining.
Thank you, Sumaira. And again, reiterating what Sumaira said, that guys, please stay safe. It is an unprecedented time. We never thought that this second wave will be so super spreader. And obviously, this time you are seeing even the youngsters getting impacted. So please, guys, please stay. Coming to your question on long-term investing, if you really see, it is about when you take this analogy with the cricket. There is Test cricket, there is 50 over match, 1 day match, which we call it, and there is a T20 match. So, markets is available to all in same sense, I would say. T20 is similar to what people do on a day-to-day basis, using technicals, using various strategies, and trying to make money. Even 1 day a match, if you really collaborate with what happened in the market, people try to make money in 1 month, 2 month kind of a time frame, or even maybe 3 month kind of a time frame. But that is also about making money. However, if you really think through the importance of compounding, and if you look at the analogy of Test cricket, uh, it's a 5 day match, and if you just extrapolate it to 5 year investment, then the importance of compounding and the wealth which it gets can created is different. So making money and making wealth is very different aspect. uh, any company also, if you take the analogy, uh, the companies are not born large caps on day one. They go through their curve of micro cap, small cap, mid cap, and then becomes large cap, and that is how they create their wealth for themselves as well as for the investors. So likewise, my humble request to everyone would be, you we all know there is T20 available, 1 day available, but the long term wealth creation is the most important aspect of your wealth building capability. Don't lose focus on that, and try to invest with at least a 3 to 5 year view to create your wealth, depending on the risk appetite you have, depending on the age and age profile of an investor. But really, I would say the power of compounding will be known only after 5-10 years of investment, and that should not be I should that should not be taken away from your investment horizon while looking at near-term money-making opportunities.
Okay, fair enough. But Jinesh, what exactly is the secret sauce of this long-term investing to get it right? Is it getting the stock calls right? Is it the ability to course correct, or is it the ability to pick what's going to do well in the future?
Correct. So So, if you really take long-term view for any company, you know what is the time horizon you are looking at for a particular sector or a particular company where you want to invest. You know this company. Let's say if we take an example, if a company is a small cap, let's say 700 or 1,000 crores market cap, but uh, the space available or the sector available where they are playing can be 100x of what their market cap is. And if the company is able to think through with a 5 to 10 year vision, if the management is able to innovate in the existing space and take on the larger players or the mid-sized players in the similar sector, the scope for growth is humongous. Also, fortunately, we are in a country where there is a GDP growth possibility of 6-7% on a structural basis, and hence many companies are available where or the sectors are available which can grow at 2x, 3x of real GDP. And if you are able to find those beautiful companies in that particular space, really we have seen at least in last 12 years in Axis, I have seen so many companies graduating from small cap to mid cap to now large cap and still being part of the portfolio, and the amount of money we would have made would be 10x or even 30x. And and that too for an, if you just collaborate with the individual investor, that would be a tax free money what they would have made, right? So as I said, the power of compounding really helps you to make money without massive taxation outgoes, and at the same time you have longevity. So for us as a fund manager also, it helps us to play through the entire business cycle from a nascent stage, startup stage, to a growth stage, to a maturity stage, and that is where the large part of money is being made.
Jinesh, this point that you raised about, it gives you the opportunity to play through a business cycle. Therefore, is it important for an investor also to align their investment horizon to this business cycle? And how do I know when I'm getting in today? How do I know at what stage is that fund's cycle, or predominantly, the number of companies there? What is the stage of the cycle, and therefore, what stage am I getting in at?
Correct. So I think, see, if you really take on a macro side, as I said, if you have 6-7% average real GDP growth, 3 to 5% inflation, uh, so you can say with clear without any doubt that India is going to grow at, let's say, 10 to 12% nominal GDP growth for next, let's say, 5, 10, 15 years. On that, if you extrapolate which sectors will really benefit, and if a fund is a part of that sector, I'm just taking an as of now a domestic
Yeah.
space, uh, and if fund is very well positioned with a long term view on those sectors, then I don't think there is any issue, because you if you really see last 15-20 years data of any fund, they would have generated decent returns over a period of, let's say, 3 year, 5 year, 7 year, and 10 year periods. And this is more to do with available opportunity in India to play long term scalable stories, because as India itself is growing, right? If India wasn't growing, then any which ways the space available would have been limited. But the fortunate part is we are still in the growth phase of the overall businesses, overall markets. And if really everything goes well, post this pandemic, can we grow at 6.5% on a real GDP growth for a structural 3 to 5 year period? Answer is yes. So I think the big picture is good. Then you go to the sectors which are scalable, and then you find out those best stories which are available.
So Dinesh, if the idea is that you play for the entire cycle, which is you remain invested for the long term, does an investor get this takeaway that near term performance may be compromised?
See, I think the problem is you start investing and start looking at NAVs on a day-to-day basis. That is not how any businesses operate, or that is not how even we operate. as a fund managers. See, idea is to buy businesses, hold it out for a longer period of time, and make wealth as and when the opportunity arises, right? So you cannot be doing great every day or every month, because obviously there are cycles in the market. There are uh, so many volatile periods on a near term basis, where you don't want to react to all the situations which are playing out, because sometimes it is like a foolhardy that you uh, try to I would say uh, churn your portfolio, or try
Hmm.
to move around looking at near-term issues and forget the big picture, and then end up losing that big picture story. And hence, that is what happens if you really see people who are playing on a day-to-day basis, or people who are playing on a monthly basis. They really miss out the big opportunity available in this market, and then they start cursing the market that it is like a casino. So I think more important is not to look at, just identify best houses or best funds you would want to invest. Look at their portfolios. Are those portfolios constantly delivering? Are those portfolios up to the qualitative mark what you want? And then invest with a 3 to 5 year horizon at least.
Okay. Um, Between these styles of investing, which could be growth or value or whatever, where does quality fit in? And I beg your pardon. How much of a role do scientific models or mathematical models play in this? I mean, how much is the role of the fund manager, and how much is the role of, say, AI in in perhaps identifying stocks?
See, derivatives, if you really, it is a derived value of something, right? In that sense. And people are using artificial intelligence on that derived data points which are available. But at the end of the day, the base is fundamentals, right? If company is not going to do well, howsoever the artificial intelligence throws data that this is the stock to buy because of liquidity, event, and all those things, at the end of the day, the base, the foundation is the fundamental, right? And if companies don't deliver, even if your artificial intelligence or big data is showing you a near term positive trends, at some point of time it will collapse. And we have seen in so many companies that have destroyed wealth for the shareholders, which were, let's say, darling of the market, and maybe some of the data analytics would be showing because of the past numbers. So I think derivatives is the derived value from the fundamentals of the company, and then you take various data points to play around, whether it is return on equity, whether it is liquidity of the portfolio. There are so many models available in the market, but ultimately the base is the fundamental, right? So long you are right in your assessment of the fundamentals of the company, I think there is space for both active as well as so-called quant-based models in the market.
Okay, just one final question, because see, I agree that you begin by identifying a company which has growth potential, and then you have to give it time to mature. Now, in
Correct.
this cycle of maturity, how much of a leeway would you give the company in terms of, when if you see that things have started to go wrong or not going according to the plan that you might have envisaged, how much of a leeway do you give them? At what time do you choose to exit or course correct?
Correct. So I can I will not name the company, but I can give you instance of in what had happened in one of our stocks. The company was came into uh, with an IPO in one of the QSR space. There was a lot of buzz around QSR, and this is old, not now. So please don't extrapolate.
I'd already
uh,
started guessing in my mind.
no. So it is 3 4 years old. So so it came into the portfolio with a thought that the management is good. There is a good brand name. They can scale up. There is always an issue whether this QSR as a model can scale up, but we thought that it could be a good story to play, because it's a fast growing space in that sense. Uh, so maybe 2 quarters there was a call we did, and then obviously company said no, the strategy is going right and all those things. Then another 2 quarters, and we said nothing is happening. What you are doing, and the rest of the QSR market was doing well. So then we really thought that management is not living up to the expectation, and maybe after 1.5 years, when we continued to do our channel checks on ground, and when we did our channel checks, we thought that the management is digressing from its strategy, despite having a strong brand name and all sorts of things. So when we got that qualitative feedback that no, this is not the right way management should be approaching in this case, because others are doing very well, and why these guys are not able to do well. So in 1.5 years, I think we took the call that enough is enough. We just knocked it off from the portfolio at one go.
Okay, wow. Okay, I know I said last question, but I have one more question because you spoke about this course correction or exiting companies that aren't along the same mind space. Um, I know you as a fund house are quite keen on ESG investing, right? Would you look at companies which have growth potential necessarily also following ESG guidelines, or could you make exceptions where you see that the company may have great potential but not necessarily ticks all the ESG boxes?
Correct, correct. Uh, Thanks for asking this question, because for us, ESG is becoming more and more important now in the overall research framework itself. So we started with an ESG fund. We launched our entire ESG process based on that ESG fund, and now we are implementing those ESG concepts even into the other funds. However, to be fair to you, I cannot restrict my fund managers or the schemes to do only ESG, because obviously there are many places where, let's say, there is an opportunity to make money for a 2 to 3 year period, be it cyclicals, be it energy, be it materials, or be it B2B stories. And maybe they might not be fitting the ESG, so-called ESG criteria on a quintile 1 or quintile 2 number. But having said that, we have restricted those investments in those portfolios to the best possible extent. But I need to give leeway to my fund managers so that they can play around in the market, depending on how the dynamics of the markets are also changing, right? So from a structural point of view, we are moving towards ESG as a framework, and even in, as I said, some leeway which are given. We are only investing into the stories where companies are really wanting to improve their ESG score. So we are not getting into companies which are into Q4 kind of a quintile or Q5. But we are trying to ensure that even if the company is quintile 3, whether some of the funds can take that bet, and whether those companies are really wanting to improve into higher scoring of ESG. Just an example again on one of the energy companies. If the future is moving towards clean energy, which is maybe gas or solar or wind power, then we don't mind taking bet on those companies as long as they are following those norms or strategy. Let's say if we find those companies, then again going back to coal-based power plants or something like that, then definitely the ESG score will just collapse, and that will not be part of the universe itself. So what we are trying to do, ESG fund, we have a very tight process where you cannot buy a low-score ESG company. Whereas for the other schemes, we have put in our score in the research itself, and that will decide the premium or the discounting valuation to be given to the company depending on the ESG score.
Right, Dinesh, thanks very much, and I hope at some point you will also join us again to tell us exactly how this ESG scoring works, because it sounds so interesting, and I guess most of us may not have a very clear idea of exactly how companies are scored. So maybe you'll indulge us
Sure,
on that in the future. Thanks very
sure.
much. Stay safe,
Thanks
and
for having me on this. Thank you.
thanks, Dinesh. Bye. All right, so guys, I hope you enjoyed this session on exactly what constitutes, long-term investing, and some of the tenets of, what you as investors should also look out for. If you have any further questions or comments, do write into the comment section below, and we'll be very, very happy to take it up. If you also have any suggestions for videos that you'd like to see in the future, do feel free to send those in as well. I hope this has been helpful. Thanks very much for watching, and stay safe.